Hi, everyone. We're going to get started in just about a minute. We're just going to give some people some time to um, enter the webinar from the waiting room. Okay, so we're going to go ahead and get started now. We would like to start out by thanking everyone who is here today. We are so excited to have you here for our Valuation Masterclass webinar, and we're hoping that you'll engage throughout the conversation and have some key takeaways by the end of the discussion. Before we officially get started, I'd like to take care of a couple of housekeeping items. I'm sure a lot of you are familiar with Zoom, but you will have the opportunity to ask questions through both the Q&A and chat icons that you can find on your Zoom toolbar. And we encourage you to do that, as both our speakers will be responding to your questions throughout the presentation. When it comes to the audio features, there will be a join audio icon as well on your Zoom toolbar, which should give you access to the audio. If you face any issues, you can also click on the audio options button, which will open your audio settings. And you'll have a drop-down menu where you could play a test tone. And if that doesn't work, you can try different features as well. And also try adjusting the volume on your computer just in case as well. When it comes to the requirement for the CPE credit, in order to qualify for this, you will have to respond to 3 out of the 4 polling questions. These will pop up on your screen as the 2 speakers will be going through their presentation. And you must also stay throughout the length of the presentation, so for 50 minutes, in order to get your CPE credit. If you do face any kind of technical difficulties, please do email elevate@armaninollp.com with your name, the date, and the name of the webinar, along with your responses to the polling questions in order to still get credit for this. So taking a look at our learning objectives for today, we have 3 of them. The first is to identify the 3 primary approaches to business valuation and the most commonly used methods within each of these approaches. The second is to describe the key steps and considerations in the valuation appraisal process. And then finally, to apply strategies to enhance value creation, the valuation process. And then looking at our agenda items, we have 4 for today. We're going to start out with an example case study background, followed by 3 approaches to value and commonly used methods. After that, we will go through a valuation appraisal process and then end it off with areas for valuation creation to increase the valuation. And so now I'm going to hand it off to our 2 speakers, who will start out with a quick intro on themselves. So Kelly, take it away.
Cyrus. Hello, everybody. I am Kelly Atkins, and I am a managing director here in Armanino's valuation and financial modeling practice. I sit in the Dallas, Texas office. I have been in valuation for over 20 years. And I just want to, again, reiterate Cyrus's thank you for attending today. I know Curtis and I are looking forward to sharing what we have learned over the years and seen in practice with you all today. A little personal side, I am married to, been married for almost 23 years. And I have got 9 nieces and nephews that I love to hang out with on the weekends and holidays. And so just wanting to give you guys a little personal side myself as well. But thank y'all, and definitely feel free to ask questions throughout the process today.
Hi, good afternoon, everyone. or good morning for anyone that's joining us from the West Coast. I'm Curtis Farah. I'm a managing director with Kelly. I work out of our Philadelphia office and have been in valuation or financial services more broadly for the last 15 plus years. I am married and I have 3 young boys at home that keep our house very loud and full of energy. I also have 2 cats and really looking forward to the presentation. And yes, of course, we welcome any and all questions, and we'll do our best to describe those as we go through them, especially if it's going to be covered within the presentation. We'll save some room at the end as well for any that don't fit neatly into the order of things here and can always follow up afterwards as well. Before diving into kind of the background on the case study and the company, the hypothetical company we're going to be looking at here today, I just wanted to give a quick overview, not only of ourselves on the previous slides, but also some of the things that we help our clients with within Armanino's valuation and financial modeling practice. So we do quite a bit of work within the M&A space and dispositions. We do quite a bit of work within financial reporting, both in terms of intangible assets, securities valuation, equity-based compensation, and other derivative type instruments, bankruptcy and reorganization, litigations and dispute resolution, as well as just overall strategic planning. And that's a lot of where the financial modeling comes into play. Customized models, value analysis for project IRRs, NPVs, et cetera, as well as 3-statement modeling so that businesses can get better insight to make decisions with in the direction they're going to go with the company, as well as the investments that they would like to make.
I would say our presentation today, Curtis, is probably more on that strategic planning side of things that we're covering today. So the other areas that Curtis talked about are definitely, whenever a transaction is completed, are necessary. But I would say our focus today is more on that strategic planning column.
Okay, well, we're pulling question 1, and it's, are you considering selling your business? And the different options we have is, I see a lot of people are already responding, is I'm planning to sell in the next year, planning to sell in the next 1 to 3, or I'm a service provider or advisor who's working with someone that's planning to sell in the next year or the next 1 to 3, or I'm here to learn and get the CPE credit. And it looks like we have most of our participants. There's a couple left here that aren't quite in, so we might give it just another second or two. Like we got one more. Great. Well, the results are in. Looks like most are here for learning and CP. And I guess learning is a good broad one, right? You could kind of fit into that as well as some of these others. But I see we also do have, a handful of people that are either considering a sale or working with someone that's planning for that. So this should be pretty relevant content as it relates to that, because as Kelly mentioned, we're going to be looking at this more from a sell side perspective and someone that's got a little time to kind of plan and properly take some steps to make sure they're increasing not only the value of the business, but what they're able to take home in terms of proceeds from that sale as well. Just to give a little foreluding.
Hey, we're going to jump into the example case study background. Here's the situation. We have a business owner who is the sole owner of his business, and he is ready to retire. He's thinking maybe in the next 2 to 3 years. Don't want anything to do with the business. They just want the cash from dad or mom or both. And it will be a taxable estate, which they want to know what the value of the business is, and he is looking into just wanting to do some personal tax planning ahead of the exit. And he's just wanting some advice on maybe over the next few years before he sells, how he might be able to increase the value of his business. And so the company that he owns currently, it's a manufacturing company in the manufacturing industry, and currently at a slow and steady growth. And I'm going to go ahead and say the slow and steady growth has been historically as well over the last few years, and is expecting to be kind of more of a slow and steady growth right now, just with the way the business is currently run. There is opportunity for growth since he only operates domestically. The key here is that he's got a diversified customer base, but no customers with any long-term contracts. And really his supplier base is really only one supplier base. He's got a salesperson that is not under a non-compete agreement. Also, a lot of these kind of businesses too, it's very common for them to not have financial statements that are GAAP compliant. And so that's the case here. And they don't really regularly prepare projections. They will prepare a budget annually, but not necessarily a long-term forecast for the business. The working capital, when you're looking at their industry peers, they are above average. Accounting and sales systems are not integrated. And, the positive here is their profit margins are higher than their competitors. But sometimes you may have to kind of dig into that too to understand why their profit margins are higher than their competitors in this case. But that is a brief background of the situation and the company that we will be primarily talking about for this session today. And so we'll go into polling question number 2. Are you, let's see here, sorry. What industry do you primarily work in? Or if you're with a service provider, you can click other.
Yeah, and as we're waiting on those results, I'll just add, within the non-GAAP financial statements, that doesn't mean anyone's doing anything wrong per se. It's just they're probably running their accounting process more from a tax perspective and planning, and they probably just don't get an audit and or have any kind of aspects within the business that are going to require one, meaning as it relates to this company, we have a concentrated ownership. There's one owner. There's not outside passive investors that are going to want to see that level of reporting. Similarly, there's no bank, interest-bearing debt or that kind of thing where, a lot of times they're going to want to see things on a GAAP basis. And if not an audit, at least a reviewed set of financial statements. We just don't have that in this case for this business as it's currently operating. So it's really just not a need within, kind of the current day-to-day. Well, it looks like we got most of our results in here.
Yes. And it looks like there are technology, some healthcare, some manufacturing and distribution, industrials, and then a big bucket of other. So that's great. Go on.
So with that, we'll give kind of an overview of the 3 approaches to value, and this relates to business or really anything you want to determine the value of. There's really only 3 broad approaches, and then several methods within each of these approaches that can be used to value, in this case, a business. One of the more common ones that people have at least heard of or might be somewhat familiar with is the income approach. And there's 2 primary methods within that both kind of operate off of the same assumption where the value of the business today is equal to the present value of the future cash flow stream of that business. And in a discounted cash flow method, you tend to use that when those cash flows are not expected to be more or less uniform on a go-forward basis. So in a high growth company, or a business where the margins are changing a lot year over year, and there's predictability and confidence in the ability to develop those projections, that's when this becomes a reliable indication of value. A capitalized cash flow method really applies similar principles in that it's the present value of the projected future cash flow, but it's run down into a single period. And you can do that when growth and margins and working capital and capital expenditure needs and really just that free cash flow of the business is stable and steady state. And you may not have, reliability in a long-term forecast. The market approach is one that is more of a relative kind of comparison. And I like the analogy of comparing it to how people buy and sell homes, because a lot of us are homeowners. And it's what are the comps and, what are they trading at versus, in housing, it's square footage and lot size and bedrooms. In a business, it's things like growth, margin, either EBITDA margin, relative size of the business. So larger companies tend to sell at higher multiples. And you can use either public companies that have analyst reporting. And one of the nice things about that is analysts also have forecasts that are put out there. So you can get insights into what not only historical looks like, but also what the expectations for the future are. And then, folks in the valuation profession and in the M&A community at large also have access to databases they subscribe to that report on M&A transactions. And so you can develop multiples, generally revenue and EBITDA based within that. Lastly, we have the asset approach. Most commonly used method within that is the net asset method, wherein you kind of walk down the balance sheet and mark to market each individual asset to its fair value or fair market value. Oftentimes, this is most appropriate for a holding company or a business with a lot of hard assets and very low margins. In other instances, it kind of presents a floor for the overall value, but might undervalue the company that produces meaningful intangible assets and value to the business. Kelly, do you have anything you'd want to add here before we move on to the next slide?
Yeah, I think the asset approach, people might also hear a cost approach, and those kind of go hand in hand. So, just to eliminate confusion, the asset approach is kind of equivalent to the cost. So,
good point. Are we able to advance the slide?
Yeah, I was having some technical difficulties there.
No problem. I didn't know if it was like a lag on my end or something. All good. So this will kind of summarize some of the things that I was kind of describing with and for those that are a little more visual than audio, it'll help kind of get those concepts synced in a little bit. So to do the discounted cash flow forecast, you really do need the forecast, and there's rigor put around, how reasonable is it? And when we think about kind of the offset around the discount rate, the forecast definitely comes into play. Is this a conservative forecast, meaning we're doing this for like kind of worst case scenario budgeting, cash, requirement needs of the business? Is this something that's more aggressive or something that's a little more base case and in the middle? All of those reflect projection risk and the ability of the business to achieve the cash flows that are put out into that forecast. The discount rate is that present value factor I was describing. So it's both just the pure kind of time value of money concepts. I'd rather have, cash in the bank now than a year from now, but it's also that risk. And there's certain elements of that are just inherent within investing in an equity. Investing in a certain industry size comes into play, as I was mentioning before, kind of the offset with multiples. A multiple is really just an inverse of a cap rate, which is a function of growth and the discount rate. And so, larger, more stable, that have gone through the progression to kind of de-risk themselves in certain ways are going to trade at higher multiples. That in turn would translate to a lower discount rate in this method. And then we kind of touched on some of the capitalization earnings concepts where that's kind of put into a single period where there's predictability and stability within the business. But Kelly, what would you want to add on to here, if anything?
One of the things I wanted to point out on the discounted cash flow method is that I think a lot of times there's a misconception of how many years of a forecast do you really need for the business. And, you really kind of need a forecast that goes out to whenever the business is supposed to really kind of be more at a steady state. And so sometimes it might, I think oftentimes you might hear, I need 3 to 5 years of forecast. But if your business is expected to be more at a steady state in 2 to 3 years, you might not necessarily have to go out 5 or 7 years for a forecast. And I think that's one of the things that, sometimes there's confusion about how long does my forecast really need to be. And so I wanted to point that out. And one of the other things too is, benchmarking against the reasonableness, aggressiveness, is it achievable? Back to that other slide that Curtis was sharing a while ago around your guideline public companies. A lot of times, we might not just look at the historical company financials and how the company has performed historically with growth and margins. We also want to use those guideline public companies to benchmark what has their growth and margins, been historically, and then how does my company benchmark to our public company competitors. And so that's a lot of times maybe like the first key in valuation is always wanting to understand the story and the background of the company and the business. And so hearing the story and hearing how the forecast relates to that story will give you a really good indication of whether or not the forecast seems to be reasonable, aggressive, or conservative. But also benchmarking against your public players in the market and seeing how your growth and margins compare also can give you an indication of your forecast and whether or not they seem achievable, aggressive, or conservative.
Yeah, that's a really good point, Kelly. And one of the other things that goes into it, I mean, we're looking at a single valuation at a point in time here, but for many of our clients, we're doing valuations on a periodic basis, some quarterly, some annually. But one of the things as we look into some of these updates that we do is how good did management do at forecasting the last time? And so just even if you aren't contemplating the sale, getting in the habit of looking beyond just the budget and what kind of expenses you think you can incur while still cash flowing the company, looking out and going through the exercise of forecasting a little bit further into the future, and what are going to be the drivers that will get you to the sales growth, and then what are the expenses and investments needed within the business to get you there. Is one going to position you a lot better if you do find yourself in a sales situation? Maybe you're not looking to sell, but you've been approached, and you might, that might make you want to think to at least consider it. You'll be better armed to start having those conversations, and you'll get better, like anything, with more repetition and over time, where you'll see where you're off. And it's just you start where you start, and then you just look to get better from that. And that will definitely happen by implementing that into just kind of the management and the strategic process and mindset and habits of the overall management team. And you'll learn where you were off, and then more importantly, it'll those are good learning opportunities to be like, oh geez, what happened, where we can maybe get a little bit better. And there's always going to be some variability in these things, but you think about large public companies, they're always on their quarterly investor calls and having to describe, earnings per share and where it's going to be. And, they really want to get to a spot where they're very close. And often, for market, reactions and things, they want to make sure they're just barely beating that budget. Private markets are a little bit different, but again, more of the accuracy, right? So it's not just like, oh, we keep beating our budgets, but, a ton. That's a great problem to have, but I'd say it's still a little bit of a problem in that you still have that variance. It's just going in the direction you would want to miss on. But over time, increasing that accuracy is one way to kind of better prepare and position your business for an eventual sale, or even if you're not going to sell, just arming yourself for where you're heading and what's going to take you there and what you need to do to get there. So the market approach, I think we covered, a number of these areas. One we didn't talk about on a previous slide is the second area with recent transactions of a company's stock. So there's financing rounds. You typically see this in startups, emerging growth, high growth businesses that need a leverage outside and infusions of capital to achieve the growth goals that go into their forecasts. And so those rounds can't and do serve as an indication of value on the company, especially when it's new capital coming in. And what I mean by that, it's not an existing investor, it's not a member of management team or some kind of related party. It really is an arm's length negotiated contract. And even if they're coming in at a different class of equity, maybe they hold preferred stock and what we're interested in for the purpose of our valuation is common. That's kind of where we come in with our technical expertise around what those relative differences are within the security as it relates to the economics around liquidation preferences or preferred dividends or a whole host of other things that could the economics around different classes of security. And then transactions where, it's not new money coming into the business, but it's existing investors and they're buying and selling with other people in the market also serve as indications of value for which you really need to start looking in at and assessing, is this the fair value or fair market value price? So
Going back.
Yeah, go ahead, Kelly.
Going back to the case study and having Curtis just go over the three approaches to value, given that the business currently has been at a steady state, a capitalization of earnings is actually appropriate. The growth expansion, if they decided in the future to do a growth expansion, that would lead to a discounted cash flow analysis, could lead to a higher valuation as long as, management has a plan in place and the people to execute the plan. The market approach sometimes was, I always this is another thing I always like to keep in mind. There's three approaches to value that you have to always consider in evaluation, but that doesn't mean you have to rely on all of them. And so a lot of times when you're looking at the smaller companies, you may want to just rely on an income approach because based on the story of the business and how the business is operating and the future plans of the business, when you compare it to the market, public comps or mergers and acquisitions that have taken place that we have data for, they might not always fit in those sectors. And so the market approach can definitely be a relevant point of data, but sometimes it definitely can be challenging. So in this case, in our scenario, the likelihood of them just relying on a capitalized earnings approach is probably pretty high. And then you wouldn't want to use the cost approach or also the net asset method because they're not a holding company and they don't have heavy real estate associated with the business that they actually own. Anything you want to add here, Curtis?
Yeah, I think the other thing that lends itself to that capitalized earnings approach is what I was discussing before, in that management doesn't have a history of creating projection. So even if they created one for this purpose, the reliability of that is going to come into question, not having any history of how the company actually performs relative to those long-term plans.
Yeah, that's another great point. All right, we are on to polling question number 3.
So where are you? Where in the world are you today?
This is fun. We have one person that's international.
Yeah.
Awesome.
Whoever that is, can you put in the chat where you are?
I know, that'd be fun to know.
Curious. If you're comfortable doing so, of course. And we got a couple other areas that are in stiff competition for who's gonna take first place here. There's a few yet to have responded, so maybe we might keep it open just for another second or two here, but please get your answers in.
All right.
All right, we had a photo finish. West Coast took it over my East Coast by 1 at the very end there.
The South is so underrepresented. And then internet, if you can, that would be awesome to chat us and just let us know where you're at.
I like that one participant put that Texas was not on there, and it's separate from the South. I think my wife would agree, given that she's from Louisiana. She considers Texas its own region. Certainly big enough for it, I think.
Somebody asked if the slides will be available, and the answer is yes. So.
And I guess before we dive into this next process, as we were kind of talking about the different methods, someone also asked about the back solve method. And that's one I didn't specifically address, but it comes into play when I was describing like the capital raising and recent transactions. It's that calibration between maybe raising capital from private equity or venture capital, or really, doesn't have to be that, but just an outside party. And generally they're taking a preferred position in the capital stack. So, not debt, not common, but somewhere in the middle that's going to have characteristics of the security that are kind of a hybrid between those two. And preferred equity is common. And there's a lot of different nuances on how that can be structured, and a lot of complexity that can come into play. But really, the back solve method uses option pricing theory to do a relative analysis on if these new investors came in and they paid $10 a share, as an example, for their preferred class, what, given the extra rights and preferences that they hold over common units, what does that imply that the common units would be worth? And there's a number of inputs and assumptions that go into quantifying that. But at a high level, the common is going to be worth something less than that $10 paid because they don't have liquidation preferences or preferred dividend accruals or certain enhanced conversion rights or anti-dilution features, or a whole host of different things that could come into play as those parties go back and forth on the negotiation of raising that capital that can be introduced. And if whoever asked that question has follow-up, please put that into the chat, and we can make time to kind of follow up and better address the specific nuance of your question as it relates to that. Okay, so the valuation appraisal process. So first, as you might expect, you got to figure out what you're being asked to do at a high level. What's the objective here? Why are you getting a valuation? Is this, financial reporting requirement as it relates to an audit? Is there some kind of tax planning coming into play? In the case of our case study here, the business owner wants to understand where they are today and what they can do to kind of plan to get a better result when they actually do go out to market and look to sell the business. But a lot of that kind of sets the foundation and the framework from which you do the analysis, and it also helps quantify what the deliverable might look like and what level of risk the appraiser might be assuming and taking on the engagement. But it's the objective, it's the purpose, it's the premise of value, the standard of value. So you've heard me say a couple times, fair value, fair market value. There's also just investment value are kind of the three that are commonly used. Investment value is more of, what would a particular party pay for a business? Fair value, fair market value are a little more generalized and kind of fair market value uses a hypothetical willing buyer, willing seller concept, and fair value uses an exit price to term as it's defined in GAAP around market participant, meaning a pool of potential buyers that could involve both financial or, like private equity type businesses as well as strategic players in the market. And then you also have to understand the ownership characteristics and how that plays into the subject interest that you're valuing, because it's not always just a broad business. Sometimes it's a 5% interest in a business or a single share of one of the classes of securities. Next, you have to kind of get a sense for the company and understand the business, as Kelly had mentioned earlier in the presentation, but you also have to understand the environment in which it operates and conducts business, understanding of the overall industry and how it fits into that, and how that fits into the broader economic landscape from even more of a macro level view. And depending on the business and its plans, that economic review could be, something that's a little more domestic. It could also include different international components depending on how the business operates, where its customers, suppliers are, what its growth plans look like, all of those different things.
And another thing that comes into play here that we don't have listed here is the valuation date, because the valuation date, you have to define that at the beginning of the assignment as well, because what you value the business today could be very different tomorrow based on economic changes that might happen or industry changes that happen, or even your company. And, maybe you lose a major, your valuation date is as of March 31st. And then on April 1st, you lose a major customer or two. And those all have influences on the valuation of your business. And, given the tariff situations that have been happening too, if your valuation date was pre all of that or post all of that, there's changes that can be happening from a tax implication to what you can deduct or not deduct from a capital expenditure perspective, et cetera. So getting that valuation date honed in on, and then what's going on in the economy and the industry and at the company can have an impact. I think sometimes I get the question, hey, how long is a valuation good for? Like, you gave me a valuation as of March 31st. Can I use it for the next, 1 to 3 years? And my answer is always, it depends. Because depending on, if you have some major changes that happen in the business over the next 3 weeks, then that valuation may not be good anymore. So I think that's definitely something to keep in mind as you're thinking about, if you're wanting to get a business valuation, just to understand the value of your business.
Absolutely. Yeah. And it's both in the business and to the business, right? If you lose a major significant customer, then the valuation you got a couple months ago, it's not going to be the same now as it was when that wasn't a known or knowable event. And then similarly, you think about COVID and, what kind of impact that had to so many of the businesses out there. I mean, there is a handful that actually got some tailwinds and benefited from that, but there were many others that just couldn't operate for a long period of time, and there was really no market for those businesses at that during that period as well. So yeah, good point, Kelly. The valuation date's extremely important to kind of lock that in. And then a lot of these others, kind of relate to some of the concepts we were talking about. I'll say, financial analysis and trend analysis, and all of this kind of goes into understanding how the company's performing relative to other companies. How is it performing against itself over time? And, what are just kind of the broader market forces at play given the business model that it has. And then lastly, it's utilizing all of that information, both, what was researched, what was provided by the company, and going through the valuation selection of which approaches are going to be appropriate that we were previously discussing, and then implementing those approaches and allocating relative weight to the different methods that were used, and triangulating on the different indications of value to finally synthesize and conclude on a single number for what that subject interest is.
Curtis, we got a question in around, I'm just going to read the question verbatim. It says, most investors use a multiple of revenue or EBITDA. How do they calculate their multiple based on these different valuation methods?
Yeah, so it would be, I guess at its simplest or most common, it would be probably a trailing 12-month figure. So you would look at, that for the subject company in terms of what its revenue and its EBITDA are for that period of time. You would look at what the trading multiples are for guideline public companies and guideline transactions in the appropriate size range and industry for the company. And that's going to give you a range of where the multiples may lie. And you're going to look against relative characteristics for growth profile, relative size, relative profitability, and a host of other characteristics to determine where within that range is going to be appropriate for the business at hand that we're valuing. So usually I would say median serves as kind of your starting point, and then you look at these relative factors to determine whether this business should be above or below that median against those metrics. And then I would say also the industry matters in terms of the relative weighting between the indication of value you get by applying a revenue multiple versus an EBITDA multiple. Some industries trade much more heavily off of EBITDA. Others, like certain ones in technology that are very recurring revenue generating type businesses, tend to trade more based on revenue multiples than EBITDA.
And in our example here for manufacturing, it would be EBITDA is what the industry is what it typically trades on.
Yep.
I know, Curtis, we got another question. It says, how important are value levers such as management team, strategic positioning, concentration? How did these value levers impact the financial valuation? They're very important.
Very important is the obvious, short answer to that question. And I think we're going to talk through some of those towards the end of the presentation when we get into for value creation. But at a high level, customer concentration would be something that would increase the risk of the business, because the loss of that customer could potentially have a big impact on the future cash flow stream of the company. And so that's going to increase your discount rate in a DCF or discounted cash flow method. And it's going to lead to a lower multiple because there's going to be more perceived risk in the business. And then similarly with a management team, if it's very concentrated, if they're not as experienced, if they're not properly paid and incentivized, or if there's just different risk elements that around, then I'd say that for the workforce as a whole, human capital, is definitely an important element in a lot of businesses.
This is where I think a lot of qualitative comes into play. I feel like valuation is you've got the quantitative process, but there's a lot of qualitative factors that go into it. And so this is where these kind of things that you're touching on in this question, this is where you add some subjective things because of the qualitative nature of management and of heavy concentration in supplier or customers, et cetera. I mean, the more diversified you can be and the more that you have your management spread across the business, where if somebody, can't show up to work tomorrow because of a major accident or something happened, you've got other people who can step in and help keep the business going. And when a buyer is looking at your business, those are the things that they're looking at and the risk that are there. And and how have those risks been mitigated. And that all factors into the kind of multiple that you're going to get on the business or the kind of discount rate that's being used in the business.
Yeah, it sounds a little counterintuitive, but for the business owners there, the more redundant you can make yourself and the more passive you can make yourself in the business to where you're still wanted but maybe not needed, the more value that's going to give you, because when you sell, presumably you're not going to stay in the business in the same kind of capacity that you are today. And so someone's going to have to kind of pick up the torch and carry it to its next evolution. So the more you could prepare and do that ahead of time, the more buyers are going to be comfortable that the business is going to be in a good state with you no longer in the same, no longer there or in the same kind of capacity.
Yeah, so this is like a key takeaway slide, which, covers, wanting to understand the company and the story and the business model and the plans. I know we're running short on time, Curtis, so we only have like 10 minutes left. And understanding the industry and just the different economic forces that are going on is really important. And again, the valuation date is important. And then the scope and purpose of why you're doing the valuation. And then it's always great if you can use more than one valuation method, but it's not required, but it's definitely, you would want to really use more than one if it's possible. So
it generally has more support, right? A three-legged stool is going to be better than one.
Exactly. So for our example case study, where we had identified some increases possibly in value could be the international expansion that the owner was thinking about. Definitely diversifying your supplier base is less risk, like Curtis was saying a while ago. Implementing GAAP financials. I know, Curtis, this is something you and I have talked about in the past. It might not necessarily increase the value of your business, but at the same time, it doesn't decrease the value of your business at all. It can only really help. I know we've talked with some clients in the past about this, and you might not see the ROI immediately, but over time, especially if you're thinking like this business owner was thinking about selling in the next 2 to 3 years, definitely something that a potential buyer is going to feel a lot of comfort knowing that you've got GAAP financials in place.
Yeah, if nothing else, it'll help, if you do get into a transaction process, it will help your certainty to close. And it will help in the speed in which you might be able to close in on a deal, because that the gap is kind of that, at least for US based businesses, that's the language everyone speaks for business, and that's how buyers are going to assess the business. So if you're not preparing that, just know that you're going to have to either yourself or with the help of an advisor kind of translate the numbers you have into something that's more GAAP based, so that buyers can kind of assess this on an apples to apples basis as they think about the valuation and what they're willing to pay for the business. It's also a lot of times the non-GAAP businesses are more of a tax-based kind of business, and many times the goal is to maximize the cash flow in a given year for the owner, and by doing that, they may not want to show a lot of profitability. So shifting the thinking into how do we kind of actually show profitability in the business and enhance the cash flows of the business, not necessarily just the owner, can also be a mind shift change into getting ready for a sale. And then kind of going further a little bit quickly here, the working capital requirements. So the more cash you have to tie up in inventory and AR and things like that, the less cash flow is available for other investments. So taking steps to not hurt your growth prospects or the risk of, stock outs on inventory. But if there's a way to kind of better manage that and operate through lower working capital requirements without having that offset and risk is something that gives more cash flow, more margin, obviously more value in that instance. Kelly, you want to take the next couple?
Yeah, I was going to say,
You want to?
one of the other things, I'm going to go to the next slide too. And one of the other things too is like some of this takes time. And so like if you're thinking about selling your business, you want to be thinking a few years out. Curtis and I were talking about this the other day. It's like you want to be thinking a few years out for this kind of stuff because this is not like quick 1 or 2 weeks. It's going to take us to implement these things. And so, is the further out that you can start planning for that exit, the better, not only just from the business perspective, but as if you're the sole owner of the business, or maybe there's only 2 or 3 owners of the business, where you can do some tax planning and strategies on what's best for you when y'all do exit. Those are the things you can start talking with folks about, like Armanino. We've got folks that can help on these kind of things too. So, but some, just quickly, some other areas of value creation that might not necessarily be related to this case study is just, again, having a strong brand recognition and reputation is actually a very big value creator. I personally had a client who was purchased just because they had excellent training videos in wound care. And this company, private equity firm, they knew that this company had this amazing training and staff for wound care. And that is the reason why they were purchased. And so, sometimes that brand recognition and what you're known for, your reputation, can definitely help with increasing value for your business. Curtis, anything else you want to add on with this slide?
Yeah, I guess to add on for the brand recognition, usually that indirectly kind of pops its head up into better margins or lower attrition or all of these other things that are a little more tangible and easier to wrap your head around why that enhances the value. And I think a lot of these others we've kind of touched on as I'm scanning it, throughout the presentation. But
in our 4th polling question, given that we're short on time, so that we can make sure people get in. What brings you to the webinar today? While we've got the polling questions still, I'm wanting to go ahead and put this last slide on, Curtis, so that folks can. I think this is a really great takeaway slide on how to prepare for a transaction. Whenever you're thinking about it, I want to touch on the quality of earnings report. That is, I always kind of analogize the quality of earnings report to when you're selling your house. You get a pre-inspection done on your house so that you know what's wrong with your house and you know what's right with your house. And that helps you pricing your house. And whenever potential buyers come look and walk through your house and they enter into a contract in your house and they get their inspection report, you already know what's going on with the house. And it tries to eliminate surprises. And so I think considering a quality of earnings report as you're preparing for a transaction on the sales side is a very good thing to do.
Yeah, it's going to come out better to learn now and either address and fix it, or at least have explanation, storytelling around, what that issue is. The other thing it does is it signals to buyers that you're serious about selling. I mean, there's a cost to getting the quality of earnings report. People don't just do that because they're interested. So it's a show to the market. Yes, I'm serious about engaging in a process.
That's an excellent point.
I think the gift and estate planning is worth mentioning here as well in the last minute, because you kind of alluded to it a little bit, Kelly, but we haven't really specifically talked about it. This is really more not so much in the business, but more for the personal financials of the owners of the business. And the planning that can take place to maximize the proceeds that are being able to be kept and retained and used by the owners. So moving some of that business interest into revocable trusts or things like that are already part of your overall planning allow you to kind of shift more of the proceeds into those types of vehicles and as a result have, a better and more favorable tax outcome. There's also a host of other strategies as a non-tax professional I won't dive too far into, or I'll get my wrist slapped by the person in the office next door to me or something. But there's different exchanges and there's a lot of really creative, sound practices that can be put in place to really accomplish the goals that the owners have post sale, whatever that happens to look like.
And one more thing, I know we're at the top of the hour, but one more thing, Curtis, that I want to bring up that you and I were talking about too, was getting a quarterback for the transaction. Designating someone in your company that could be the quarterback, or looking to your consultants, advisors, because you have to keep running. If you're looking at selling the business, you have to keep running the business so that the potential buyer is going to want to buy your business. But selling and preparing for a transaction takes a lot of time. And so it can be really overwhelming to try to do both. And so if you find someone to help you quarterback that process, can be life-changing for you to help with some of the stress relief on that.
Absolutely. It's a second job to go through a sale, and it's different. Operating and running a business is different. It's a different skill set across a lot of different disciplines than engaging in an M&A process. So even people you have on the team that are trusted may need to be supplemented with other more positional type experts. It's kind of like your general physician versus your surgeon, kind of an analogy. So getting the right team in terms of your accountants, your financial advisors or investment bankers, your attorneys, your insurance folks, there's certain reps and warranties and coverages and things that you can do around insurance. M&A is a whole discipline within the legal environment, and there's people that specialize in just that. And I highly recommend utilizing that as someone that's more of a generalist corporate attorney. You want to vet these people by asking what their experience is, how many transactions have they done, what kind of work have they done in your space, and all of those kinds of things as you assemble the team. And then there's a whole inside team, and there's a lot of consideration that needs to be done. And who do you bring in? When do you bring them into the conversation? Obviously, the CFO of the business is someone you need to pull in early. And kind of to my point of making yourself a little more redundant, if you're engaging in conversations with buyers, having the rest of the team be able to address and speak up and address questions is going to give comfort to the buyers. So, it's not that the owner doesn't need to talk, but if they can talk less and allow the others on the team to really pipe up and answer the questions, and they have the confidence in those people to address those needs and questions, it puts the business in a better position from a buyer's lens.
Well, y'all, thank y'all so much for attending the webinar today. If you have any questions, definitely, I think as you're closing out, you can chat in there and we can follow up with you. Have a wonderful rest of the day.
Thanks, everyone.